So just a quick recap of our PEA and the economics around that. This is just the sensitivities at various gold prices. And the base case was run at $1,650 an ounce. That produced a robust set of economics, including a NPV of 285 million and a IRR of 35% on an after-tax basis. What's more relevant today is where gold is at, and that's around 1950, and that is our upside case, where the project produces a after-tax NPV of 460 million, after-tax IRR of 50.5%, and a very attractive payback of 1.3 years. Overall, the PEA was scoped with a 8.3-year mine life, producing around 100,000 ounces per annum at a very favorable strip ratio of 3:1. I certainly haven't seen a better strip ratio across open pit gold projects in Canada. The all-in sustaining cost of $889 an ounce, that's certainly very competitive if you look at other projects, and a very modest capex of 234 million, which includes a 17% contingency of $34 million. While Goldfields is at a PEA level, it's a substantially de-risked asset for a project at that phase. And the reason for that is in the PEA, we use 99% of indicated resources. Those are resources that are higher confidence category than inferred resources, which are typically used at a PEA stage. So we have greater confidence that the resources are in the ground, which de-risks the project. From a mining and processing standpoint, this is a conventional open pit mining. There's no encroachment into water bodies. It's very competent rock, very little in the way of structure. There's been numerous studies to show, very limited risks from water inflows, from the competent geology, very low strip ratio, as I mentioned. The mineralogy is very simple, allowing us for a standard free milling flow sheet. This is an industry proven conventional flow sheet. And then from the infrastructure and permitting point of view, some very key attributes to the project, including the established infrastructure in the Uranium City area. That includes a road and a power line to site. Uranium City itself has numerous facilities, including bulk fuel, civil contractors. And importantly, Uranium City is a historical mining area. There's a precedent for mining in the area. There's a community that has relied on mining and that understands mining. And those are all positive attributes in terms of taking this forward. So, the environmental and social risks, none have been identified that can't be mitigated in terms of developing this asset. Also, the project has a valid development permit that was granted in 2008. That's for the open pit mining of the Box deposit and a milling of 5,000 tonne per day. What's important is that the project has been screened environmentally. It's already got a vast repository of baseline data, and all those are going to be used to, expected to facilitate their timelines toward production, no matter how the project gets scoped further at a PFS level. If we look at Goldfields against peers in the space, and here we're comparing Goldfields to other Canadian open pit gold projects with studies completed mostly in 2022 at similar gold prices, and you can run your eyes down the gold prices on the right. So we feel we can make comparisons in terms of the economics. Firstly, on the grade and production, as an open pit project, our average mill grade is 1.2 gram a ton. That certainly compares very favorably, if not better than a lot of the other junior developers in the space. And from an average annual production point of view, shown by the dot on this top chart, that is certainly competitive in terms of average annual production. Initial capital, as I mentioned, very modest at 234 million, which adds to that quick payback on the project. And then the base case economics, producing a really compelling IRR on our base case of 35%, obviously that moving to around 50% at our upside case of 1950. So a really robust and competitive project amongst peers in Canada.